I'm glad you said that before I hit record.
No, we like to really manage expectations.
Okay. We'll give everyone a minute just to kind of get set up, and then we will get started.
Look at this. We got the A team on here.
What's up, Jeff?
What's happening, Gil?
How you doing?
Good. I surfed this morning.
Rub it in. All right.
Yeah, got to tell people that either going to be jealous or care. I think you qualify as both. So
Yeah.
All right, it's 12:01. We're going to get started. So thank you everyone for joining. Jeff is going to introduce our host in just a second, but I did want to share something with everybody really quick. I'm reading about Brad and kind of learning more about him, and I came across something that I would like to share. I didn't realize he was a star. Hold on. All right, I just want to share this one. It's really quick. We have a celebrity with us today, and I just want to showcase.
Domino's has a $7.99 Monday through
Don't
Thursday.
blink, you'll miss it.
You carried out Friday through Sunday, you might have felt bamboozled. So we're extending the deal to every day and giving people who paid more a little payback, like the Smith family, who got free pizza for a year. They love pizza. We gave Rajesh a new nightlight. We gave Ani a part in this commercial. Take it away, Ani. Action! Brad got to spend the day with the Noid.
yeah.
Where's he been? And we gave Alex
a pen.
Payback. Go to pizzapayback.com for a chance to get yours and carry out large 3-topping pizzas for $7.99 now every day.
Okay, sorry, Brad. I couldn't resist. I
Hell yeah.
to share with the group.
It's great. Look, I'm 0% actor or at all famous person, and the very short story with that. At the time, my roommate was dating this girl, and this girl reconnected with one of her friends, and turns out she was a casting agent for Domino's Pizza. And she was like, "You should meet my boyfriend's roommate. He's disgusting and eats like one pizza every day." And then I got that weird opportunity, and then it went to TV, and then it paid for half my wedding. It was like the craziest thing ever.
That's great.
Yeah.
Great.
So follow your dreams,
Awesome.
kids.
Well, thank you for letting me share that. All right, Jeff, if you want to kick off and introduce our lovely host.
Absolutely. So I'll be moderating today and kind of guiding the conversation, but I want to introduce Brad Gilboe, our host for today. Brad is a good friend, met him many years ago at a Keller Williams event, and we instantly hit it off. I met you kind of at the beginning of your real estate investment career, and it's been really fun to be friends with you, bounce ideas off of you, and watch our real estate businesses grow. And not only that, but your investment real estate portfolio grow. You're just I'm lucky to have you as a friend and a teacher. And so with that, I want to introduce everyone to Brad Gilboe.
Hey, man. Well, it's different for everybody. Man, thanks for the kind words, for the intro. I mean, as you know, this is a topic that I'm super passionate about. So I guess what I would preface this by saying is I can tend to get a little wordy with everything. So if you need me to zip it or cut it short or be more concise, please edit me. But yeah, you're exactly right. I guess the big takeaway here, and the reason that I'm passionate about this, is achieving financial independence, or where what we'd call your passive or your horizontal income can meet or exceed whatever your living expenses are, is really powerful. I think that we can all agree that the real estate business is changing, and I think that we would all be foolish to think that our role would be the exact same as it is now in 5 or certainly 10 years, right? Like, commissions are being compressed, companies are doing more interesting and disruptive things, and so I want to be able to make the best decisions for me and my family. And the biggest way to do that is to have financial security, right? So that's the bottom line. I am not a very intelligent man. And so real estate is the easiest way to just sort of follow the roadmap of people ahead of me, and really provides a nice, one, there are certain benefits being a real estate agent, but then more importantly is that it really helps to absorb some of the mistakes that you can make and really time sort of corrects everything, if that makes sense. So that's it in a nutshell. Oh, let me just say one other thing. My goal in all of this is really if nothing else, my point is, as real estate agents, when deals come across your desk, the biggest thing you should be asking first is like, should I buy this? Like, and then how can you go to like analyze that deal? Does it fit your criteria? Like before you just call some other investor and effectively give that person a gift or equity or a wealth building tool, just ask yourself, like, does this make sense for me and my financial goals and timeline? And we can talk through like how you can better analyze that. But that's the biggest thing. Just take a beat before you go and call somebody when you hear about that fixer or that off-market duplex or the, you know, your grandmama wants to sell her house, and you get my point. So that's kind of the biggest takeaway.
That's good. That's a great goal or mindset that you could all share with us and how you got there. I'd like to start at the beginning. How did you can't just, if that great deal comes across your desk, you can't just jump on it if you're not. When luck presents itself, you have to be prepared to get lucky. So how did you prepare yourself when you're kind of that pre-first investment property? What lifestyle changes did you make, or what books were you reading, or what were the biggest, most impactful steps that got you ready to execute on that first opportunity?
Yeah, totally. So the bullet points kind of worked out like this. I'm originally from Detroit, Michigan, or the suburbs of, and I bought a house in 2013, a single family home that some family of mine lived in. So I bought it because I was already paying, I had a pretty significant financial commitment to some members of my family. So I was like, look, if I'm paying everybody's rent, let's just move them into this house, basically. So I bought that because I would sort of become enamored with some of those, you know, flip or flop, like HGTV shows way back in the day, like before anybody was really outlining it. And so like, I thought it was a cool and sexy idea. Didn't know how to analyze a deal, didn't know what return, you know, cash on cash returns were, didn't know anything about anything, but knew that I was paying rent, would buy this house. Really enjoyed that process. And then my now wife was the one who bought me this online real estate school, which is then how I got my license. I was still working a W-2 job. When things started to pick up in real estate, sorry, let me step back. When my wife and I moved in with each other before we were married, probably even before that commercial aired, we were both making pretty decent money at our W-2 jobs. And she kind of came to me with this realization that we were working really hard and we didn't really have a whole lot to show for it, right? Like LA is a higher cost of living area. So, you know, you got to be making 80 grand a year just to not have roommates as an adult and like, you know, like want to have a laundry facilities in your unit. We were still renting and basically we realized that we didn't have enough to show for how much we were earning. So the first thing was that we got really clear with our finances, and that included like heavily leaning on like some Dave Ramsey teachings, which I agree and disagree to some degree. So the point was that we created a budget that, even though it wasn't right, like we just did it, what we thought we spended. Then we started tracking what we spent, which there's a huge discrepancy between those two. What you actually spend versus what you think you spend are very different. And then the third thing is that we just continually reconciled that budget, meaning we were meeting every other week, talking through how much we had for like our, you know, eating out budget or for this or for that. And so we got to the point that we identified what's like our savings rate on the budget that we had. So I knew that when I got paid at the first of the month, then I could keep that savings rate. I don't know if you guys are familiar with, there's a book called Profit First. And it's basically that concept, right? Like paying yourself first and then everything else should fall in line in your business. But as real estate agents, specifically with making like large commission checks at one time, oftentimes we're not smart with our money. We're not living on less than we make. We don't really have a plan. It's kind of like money comes in, money goes out. So I guess the biggest thing was getting intentional. Then I got into real estate and frankly started making better money. And I was really thankful because like, man, if I would have, if large amounts of money would have started coming in when I didn't have that financial discipline that we got from like being on a fixed budget, then I don't know what I would have done, right? And so I guess like this is a long-winded way to answer your question, is that I had my financial house in order that basically got with my wife and I being intentional about what was important to us. And so we said no to some things, said yes to other things, but got on a budget, tracked it, identified our savings rate, and then just stuck with it.
Can I stop you real quick?
Yeah.
So you mentioned Dave Ramsey, and you also mentioned Profit First. If someone on this call had never read a book ever on budgeting or finance and was like basically just floating in the wind with their finances like so many of us have, what book would you recommend first? So just to get a foundation, gets started. This is a good foundational book to get that discipline started.
oh my goodness. I mean, Rich Dad, Poor Dad is probably the best way to just understand like the value of money and how to like put it to work for you. But
Okay.
Dave Ramsey, Total Money Makeover is excellent if you're in debt, if you don't have a budget, if maybe one of your partners isn't on board. Like he has his baby steps, which I agree with like the first 3 or 4. Although Dave, this is my diatribe. Dave Ramsey is very against debt. So he's like, cut up your credit cards, which I agree that consumer debt is not a good thing. But when you understand the wealth building power of real estate, I think, and many other people that can use debt responsibly, understand that that leverage, healthy leverage, is actually like the key to really growing your real estate portfolio. So I guess it's a marriage of the two.
Cool.
Yeah, that's if that answers your question.
No, I think that's good. I've read Robert Kiyosaki's Rich Dad Poor Dad, and I have not read Dave Ramsey, but I feel like I should, because I think those foundational steps are huge. We got to start with cutting up the credit cards before we can responsibly use. We got to stop irresponsibly using debt before we can responsibly use it. So I like that.
Yeah.
So sorry, I just wanted to get
Sure.
that in there for anyone that was looking for a book recommendation.
Yeah. Okay, so now continuing on, right? So then all of a sudden, and to speak to my point about the financial independence stuff, so I started also listening to Bigger Pockets, which is like it's a website, a real estate investing website and forum, but it also has a podcast component that like I was just consuming because I was driving a lot and I loved it. So as I started to understand more about the wealth building power of real estate, and like, okay, I wanted to put this money to work, and knowing that I couldn't be an agent maybe forever, that's when I started having conversations with my wife about like acquiring properties and doing different things. Now, truthfully, she wasn't on board right away because I was framing it in a way that she thought that I just wanted money. And she is someone who is not 0% motivated by money, like really could care less, right? Like wants a quality of life, is present. We balance each other well in that regard. So this is when I had to really get clear with her that like, for me, money doesn't mean that I can go buy like a Rolex or, like a Lamborghini. For me, it translates to security, right? Like I'm from Michigan in 2008, 9, 10, many people of my friends and family lost their homes and, they got foreclosed on, they lost their jobs. Like it was a tough time. And I realized that I didn't want to be beholden to somebody else to depend on that paycheck or anything else. And look, I don't know what's going to happen with Social Security. And like, I'm not a pessimist, but my point is like, I didn't go to college. I really, outside of this, I have no applicable skills in the marketplace. So like, you know what I mean? I really need to hedge my bets. So when I explained to my wife that like the passive income from real estate effectively represented security for ourselves and for our family, and hopefully the ability for me to retire by 45 or 50, and then only choose to work if I wanted to, it was a much different conversation. So now she was on board. So then we selected Michigan, which now I'm not actively investing in Michigan for, it doesn't meet our investing criteria now, but at the time I had people that I trusted, right? Like I had family members that could go and walk a property. I had a trusted real estate agent. I didn't have a property manager and I didn't have a contractor, but I felt confident that I could figure those things out. So that's why we arrived at Michigan. And then also specifically found this duplex that was $135,000. So, I mean, I don't know what your average price point is, but like what 135 in LA gets you a car. Like you couldn't buy anything for 135 grand. So this duplex was one 2-bedroom unit on top and a 3-bedroom unit on the bottom for 135 in a very blue collar, like salt of the earth, like just like, good rental market. It was also turnkey. So like the guy had used it as a rental. And the short answer is that I had to come up with $42,000 ish because I had to put 25% down plus some closing costs and a few other things. And so it cost me 40 grand to get into this rental unit that, like, if I'm looking at the numbers, like it cash flows a bit, not as well as I thought that it would, but it does. And so the reason that I wanted to pull the trigger on that was because, one, I knew that market. And then also, if everything fell apart, it was a relatively lower price point. Like if worse comes to worse, I would just put it back on the market for 135. I'd lose the 6% commissions, whatever. You know what I'm saying? Like, but like at the end of the day, like losing 8, 10, 12 grand would stink and is not ideal, but it wasn't enough that it was going to bankrupt me. So it was a really good way to like test this process with my wife, see if it worked, kind of like get her comfortable with like owning something we'd never seen in person that was out of state, and then just exercising that muscle, which was part of my larger plan to like take down bigger deals.
So the people on here who have never bought an investment property, would you recommend that kind of just pull the trigger on something? Like, obviously don't be stupid about it, but pull the trigger on something just to get some reps in. You're probably not going to hit a home run on your first one, but you'll learn a lot. Would you recommend that strategy?
100%. You taking imperfect action trumps taking perfect action every time. So and I'm not saying like just go buy the first thing and overpay market value and like, whatever, draw against you get what I'm saying? Like you want to run your numbers and be conservative, but there's also like, if you know, that guy, Tim Ferriss, he talks about like he runs like a 3 scenario process, right? Like you've got like realistic, like what do I think is going to happen? What's likely to happen? And then you run your realistic worst case and you run your realistic best case. So, actual worst case would be like a meteor comes out of the sky and you cuts off your legs and then you live and now you have no legs or something to that effect. But like what realistically would happen is like, oh, I bought this property for like 135. I thought I could rent it for 1,800. Turns out rents are 1,500, and actually the property was probably worth 115. So now, like I'm in the hole, whatever X amount of dollars. And then, so do you get what I'm saying? But at least then, like it as a high C personality and analysis paralysis being a thing that prevented me from moving forward, there is comfort in getting information. And in fact, most of my hesitation just comes from a lack of clarity and a lack of information. So if I just know what the risks are, then cool. And I can make a decision like, okay, well, do I want to risk 10 grand here to potentially make more? But when you get into the numbers, you'll find that most of these moves are actually asymmetric bets, meaning like there's very little downside and a potential huge upside. So if that answers your question, yes, take action. Yeah. Maybe don't take on a full, huge renovation like right away or something, or, build a ground up 10-unit apartment building, but like, a little bit of whatever, kitchen, carpet, bathrooms and painting and like a house that makes sense and you get a screaming deal, like you really can't go wrong.
Okay. So what were from taking action on that first property, before we move on to the next one, what were your biggest, I don't know, we can do 1 or 2 things right here. You tell us your biggest ahas, or we could open it up for questions on that specific property. Is there more you want to share about that house?
Well, there's one thing in particular, which is just be conservative with your numbers. A perfect example, I didn't know this, and my realtor, who was not an investor, didn't know, but because I'm non-owner occupied now buying in Michigan, my first property, technically I'm a homeowner, like it's, okay, my point is that like the taxes went up because it's non-owner occupied. I didn't know that. So my monthly, my PITI went up from like, I don't know, like $775 to like a little over $1,000. So if I was aggressive with my numbers and didn't have the proper like budgeting, I could easily not be cash flowing. So like right now I'm looking at, actually, can I share my screen? I'll show you the numbers on this one. Is this it? I think so. Wait a minute. Yep. Can you guys see this?
Yes, sir.
Okay, so this is what it looks like right now. So I bought it for $132,500. These are my closing costs, 25% down. No rehab because it was already like previously a Section 8 rent. $384 is what my taxes are. They were supposed to be like way less than that. So in terms of like, now I manage this myself. So I am the property manager. So there's 0 to the property manager, although 8% of rents is what is like pretty common in that area. So that could be $134 a month. And then the other things that you want to set aside for are vacancy. Vacancy meaning when people aren't in the unit. Repairs, which are things like broken light bulbs, broken toilets, and then CapEx stands for capital expenditures. These are things like your roof, your water heater, your windows and siding, longer term things that you have to pay, but you don't want to get hit with a $10,000 roof repair 1 year. You want to have buckets and be planning for that. There's no miscellaneous, the guy upstairs like mows the lawn, like there's no snow removal, like nothing like that. So the rental income right now is $1,675, right? The upper unit I get $775, the lower unit $900. So my monthly PITI, right here, is $1,043. So I'm basically, my gross profit is $450 a month. So the return that I often use is cash on cash. So this is a 14% cash on cash return because I'm earning $5,400 a year, or a month rather, no, a year, sorry, divided by my initial investment of the $38,000 down payment plus closing costs gives me 14%. You follow that math?
Yeah.
So like I had to come out of pocket 38 grand. I'm actually making 5,400 a year. What does that look like? A 14% cash on cash. So that doesn't factor in tax benefits, that doesn't factor in property value appreciation, and also like rents could go up, right? So but if you were to tell somebody like, hey, I'll give you, give me $100 and I'll give you 114 in a year, like people would be thrilled to get a 14% return, right? So anyway,
Yeah.
that's actually like what the numbers look like. Now, let me be clear. Oh, actually, hang on. I think I put my notes here. So this is a high cash flow play, but it's low appreciation. This part of Michigan is not like, this ain't where everybody, in 10 years, this thing will be worth like 137, right? Like we're not experiencing like incredible growth here, right? This isn't like the hipster market, right? The other part of it, because there's no value add, my equity in the deal is my own money that I came out of pocket with. So that's important. If you were to do a value add where you're adding value or raising the value, like that's where there's like, there's a certain return on your money, if that makes sense. Also, don't get hung up on the market, right? Like, not to say that Centerline, Michigan is like the hottest market in the US. Centerline market was just a market that I knew reasonably well. I had people, and I just made a decision, right? People get so hung up on like, should I go to Florida or Indianapolis, or should I go to any of these hot markets, depending on whatever Wall Street Journal article comes out, right? Like, and at the end of the day, it was an asymmetric bet. Worst comes to worst, if I couldn't rent it or if it was a total disaster, I'd pay 10 grand in closing costs to get this thing sold, and I would just learn an expensive lesson. So anyway, those are my takeaways. Any questions on that one?
Yeah, I have one, and then we'll open it up to the group. The 3% capital expenditure line.
Yeah.
Where do you put that money? So okay, let me just tell you my assumption and tell me if I'm right. So let's say the roof's going to be 10 grand. And that's not going to come for 7 years. So you want to be prepared in 7 years, right? You want to have that money building somewhere. Where do you hold that? How do you know that that's at a safe place and you can calculate it?
Sure. So, I mean, in short, it's whatever works best for you. For me, I open a separate checking account for every property that I have. And then all the money comes in and out of that, right? That way it's easier to track. When worse comes to worse, I can go and look at everything that's coming in and out. So I don't know that that's the best way. The other thing is, and again, speaking to like your having your financial house in order, I don't need any of this money. So the money from this account, from the rental income, like it just grows in an account, right? That's how I do all my properties. So then if I needed to, I could just pay for the future repairs out of that, if that makes sense. That's also where I keep typically 3 to 6 months of expenses for every property as well, right? So I don't keep a lot of cash on me personally, because I want to put my money to work, but I do keep healthy reserves of 3 to 6 months for each property because, I don't know, let's just say a global pandemic hits and suddenly tenants stop paying rent. And now all of a sudden in addition to paying your own mortgage, you have to figure out, how you're just like, you're just hemorrhaging money. So like I had access to lines of credit as well as reserves. Now, thankfully, all of my tenants continue to pay. Anyway, that's my point. So one bucket, which is a bank account, a checking account that I have access to, everything comes in and out of that every month.
Understood.
Are you just letting that build up over, like, if you got 3 months on multiple, as you start to scale, like that becomes like a lot of cash that's sort of sitting there for cash drag. Is your philosophy to just look at each one of those properties in silo and assume that a pandemic might hit and you really want that security across 3, 4, 5, 10 properties or whatever? Or do you like think like, all right, well, if I've got a portfolio, I'll keep a certain level across the portfolio because those roofs aren't going to come at each time, or assume that they all overlap? Like at what point do you start to think about like, oh, I should be investing in another 14% cash on cash return deal to have more cash flow instead of letting that cash just sit there?
Yeah, that's fair. So
high quality problem, but
no, you're totally right. It's interesting. I had a conversation with a buddy of mine in another like investing sort of like mastermind group that I'm in, and he called me on the same thing because I wanted to buy a new car, which is like a big thing for me. And I was like, I should get a property that pays for that car. And then he was like, dude, you're thinking like so small, like you make X amount, like this is just one other expense, like just make sure it works with your total financial picture. So, but to speak to your point, I just keep everything in those buckets. It hasn't been like so incredible that I would like put that money away. But like, I mean, actually for this particular, I mean, truth be told, on this particular property, I had a family member move into the lower unit. So like, it's basically barely breaking even. So this one is just like staying afloat, which is fine. But I have another property that I'm cash flowing. That first property I bought in 2013, dude, that thing is like the best. I had family and then I had bad tenants. I almost wanted to just like burn it down. I was so sick of that property. I kept it and then got actual tenants in there with a property manager. I never even deal with anything and I'm getting $800 a month from that property. So like that thing is, now the question becomes with that, sorry, I did return on equity because it's gone up in value and I paid it down. But to answer your question, there's way more than 6 months of expenses in that account. And at some point I may take whatever that, $5,000, $6,000, $8,000 and put that towards like another purchase in unison with maybe some other things. But for me, like, I'm a little less worried about if it's 3, 4, 5 grand. I'm now making like bigger picture purchases with stuff, if that makes sense. But like when maybe we'll get there, but I have like a 10-unit apartment building in Phoenix that's like really producing some really great cash flow. And at some point, yeah, I'm going to pull some more money out of that and then go buy another apartment would be the idea. So I guess it's sort of like whatever feels right for you. But I'm not sitting on a ton of cash. If I got to the point that it was like over 10 or 12 months of like fixed expenses for that particular property, I'd probably move it to something else, just knowing that I would deploy it elsewhere.
Great. Does anyone else have any other questions about that first transaction or preparing yourself to buy an investment property?
Yeah, I do. Do you set up a separate LLC for each property?
Great question. There's a lot of debate. The short answer is no. You don't really need that, I don't think, for your first few. Now, for the 10 unit that we bought in Phoenix, we did. And also, like, frankly, as my net worth goes up, then I'll probably start to move some of these things in. But like, you don't, I mean, no, I think you're all right. And also if you wanted to do, I get conventional loans for this stuff, right? Like this was an MLS deal that I bought with 25% down, like a Fannie Freddie loan. So they will not lend to corporations. So if you needed to, like, you could create an LLC certainly, and then just you could quit claim it into that after. But I don't think that you need to do that, right? And in fact, like even the properties that we have here in Los Angeles, one that we just finished, we'll talk about, my primary residence, and then another development opportunity that we're working on. I hold those in my personal name.
Cool. Anyone else? Okay.
So let me just say, so one last thing with this. So look, the reason that this worked is because when we decided that we wanted to do it, one, I had the 25%. So I had the down payment because we'd been saving our money. Our credit was in good shape. And then also, like, I had good financials for my business that was already running profitably, because any lender is going to want to see your P&L. Luckily my wife is W-2, but like, my point is, like, I had our financial house was in order, that when this opportunity came about, then I could do it. Right. So that's the other thing. Like, you can't be the person who's like defaulting on your credit cards, or you just went and leased a brand new car, and like, you have all these, your debt to income ratio is like out of alignment, right? And so like, you're just like the clients that we serve, like you need to meet those certain lending criteria to be able to pull the trigger when the right thing comes along.
Cool. So I think that's a good segue from the Detroit properties or the Michigan properties to Rangeview, the one in Highland Park.
Yeah,
that was an interesting one. I think a little bit different than the Michigan properties, and it kind of exposed some other strategies and questions and answers. So tell us about that one.
sure. So this one is okay. Originally I purchased it as a flip. And in fact, I think I've got the flip numbers here. Yeah. Okay. Let me share my screen again, if that's okay. Do you see this?
Yes.
Cool. So this deal came to me from an agent to agent relationship, meaning another licensed agent that I knew was on Facebook talking about this fixer that he had in Highland Park, which is sort of like, it's like a quickly gentrifying, like, hipster area, right? Like, it's changing, and the growth is just going to be incredible. I had sold another property to another investor over there, a smaller house that they turned around, added some square footage, and fixed it and flipped it. This one I liked. It was basically, I didn't know what they wanted, but I bought it for 800 grand. Man, so many things. Okay. Okay, sorry, let me give you the numbers first. So we bought it for 800 grand, closing costs were 20. The $200,000 was my down payment, and my rehab actually ended up being more like 215, I think, because we put some extra things in here. So all in all, it was going to cost me almost $6,000 a month to carry it. And it took 6 months, which is longer than expected. But the COVID permitting, adding a bathroom was tough. And basically, anyway, so it was $6,000 a month. So I'm all in for like $1,050,000. So a couple things. One, the down payment, the 200 grand, I didn't have that liquid. What I do have is a home equity line of credit on my primary residence that I can borrow against for situations like this. So we renovated our house. It's worth a lot more than we owe on it, but I don't want to have a huge mortgage. So what I did is I originated a home equity line of credit, which is now what I can borrow against for certain investment opportunities. But frankly, it's also my emergency fund, my personal emergency fund. So when COVID hit and everybody was like, hey, go home, like we're not selling houses, and I had escrows that canceled, I knew that I could not earn any money for a whole year if I needed to, and just slowly draw on this line of credit, right? So that's how I hedge for myself against not keeping large cash reserves, because it's not good for inflation. The point is you should always have your money working, in my opinion.
So that home equity line of credit was established way before you did this fix and flip, and it was there not even intentionally to make down payments with. It was just a smart decision to create security for yourself. Is that correct?
Partly it was for investments. My plan was like it's a $350,000 line of credit. So my thought was like, well, shoot, if my plan is to buy $135,000 duplexes in Michigan, I can buy these cash and then maybe be more aggressive and find more distressed sellers, or buy properties that don't fit financing requirements, fix them up, and then basically secure financing after, right? So
finance them and pay off that HELOC.
Yeah. But so yes, it worked for like my own personal emergency fund or line of credit, but the intention was always to use it for more investing.
Okay.
So I did that. Now the $200,000 rehab, this was the first time that we secured private money. So we basically got 50 grand from 4 different people, 2 friends and 2 family. And we structured it like where we had promissory notes, and we agreed upon an 8% interest rate. And these are people that already knew us and liked us. So that's the other thing. Like once you start doing things, like there's a cliche that like, if the deal is good enough, the money will find itself. And like, that's so true. And I didn't think that'd be the case, but like, because this kind of comes out of order. We had already done the Arizona property. And I think people knew that I was a conservative person with my investing, and they knew that I knew real estate. So the point is, it was not difficult for us to get the 200 grand that was outside of escrow. So it doesn't show up on my credit, and I could use that to fix up the property. So you guys following this, right? Buy it for 8, you put roughly 200 into it. And then, I'm all plus clearing costs, I'm all in for $1,050,000. So the rough numbers was that I was planning on selling it for 1.25, which even at 4%, meaning 2.5% to the cooperating broker, is pretty common out here. 0% to me as the agent, and then maybe 1.5% in terms of closing costs. That's how I arrived at this number. So my gross profit was going to be 1.2. If you remember, I'm all in for $1,056,000. That means that I'm making 144. But then I still have to pay taxes on that, more specifically my own taxes and my short-term gains. So then in California, I'm basically giving away half of that, is the short answer. So I was going to walk away with like 75 profit on a $220,000 investment, if that makes sense. So it was going to be a 34% cash on cash return. You guys following me this so far? Right? Yeah. So I'm going to do the whole thing. I make $150. But then after all is said and done, when Uncle Sam gets his cut and I pay my closing costs and whatever, I'm walking with 75. Not bad, except that I spent 6 months and a lot of time and energy and money on that deal. But it could have worked out perfectly. But I did decide to keep it, which I'm happy to walk through if that's interesting for you guys as well.
Yeah. So basically you're saying you analyzed it once the home was prepared to sell, and you realized, oh wait, I can hold this and rent it out. And I think that's a great transition. Like what brought you to that decision?
Sure. Okay. Well, let me also say too, like with this one, it was a full gut. Like we took this thing down to the studs, but it was not all that different from what I did for my own primary residence, right? Like windows, drywall, insulation. We added a bathroom, and I already had like an architect that I was friendly with. So my point is that like I just locked this up under contract. This is my point. When the opportunity presented itself, I didn't try to lock it up to then call another investor. I said, man, a year ago, like I saw these guys do this down the street. Like, look, I'm a resourceful dude. Let me at least investigate this and see what it costs. So I put in, I ran some rough numbers. I met with a contractor that I knew and figured it would roughly be like, I don't know, 175 to do all the renovations that I wanted. And so then I could write an offer and lock it up. And now the other thing that's important here, look, this agent who had it should have taken it down himself as well, in my opinion, but he didn't, and that's fine. So I came in, but being a licensed agent, I could represent myself, but then I further incentivized him because I think he signed it at like 6% or something. And so I incentivized him, and I was like, look, I can give you a referral fee from my commission. So like basically it was more, he made more money by me buying it. But then truthfully, the sellers didn't see that. So the sellers, we still had separate agency, if that makes sense, right? He represented the sellers, I represented myself, but I had another deal where he was getting taken care of. All very legal, but like the sellers didn't necessarily know that he was. So now this guy's like really going to bat for me, and he's telling me everything about everything, right? It's basically like all those terrible clients that come in when you're working in open house and they're like, we want to deal with the listing agent directly. It's like that, but like it really was that. Except that I was running the numbers myself. So that's one part, right? Like you can get creative in the way that you take down the deal because the whatever $10,000 in commission that he was going to get extra was a big deal for him. But I'm looking at the big picture here. So that's one thing. And then the other part of it is like, just like everybody, this wasn't an as is, like you write, no contingencies. I had an opportunity to do my inspections. And so I checked out the sewer line, I checked out the foundation, and I had other tradespeople come in to basically verify that my scope of work and my budget was like pretty accurate. Does that make sense?
Yeah, well, that's my question just popped in my head. Why'd you check the sewer line? There's not a first, I think I know why, but it's not a first thing I would check on an inspection.
Because I know I got to rip up the floor and put in a kitchen. I know what that costs. But if the sewer line is shot, that could be 15 or 20 grand, depending on how big or bad it is. So like, I wanted to make sure, I just didn't know. Right. And like, if the foundation is crumbling and there's going to be all these issues, well, that could be costly as well. So everything else I didn't care about because I knew I was going to rip it all out anyway.
That's a great reminder. Just I deal primarily with new construction. So checking a sewer line rarely comes up in my regular transactions. So, but if you buy a home that's 50 years old in Los Angeles or shit like 80 years old in Los Angeles, that's something you're going to want to check, or New Jersey or anywhere that has old homes.
100%. Yeah, man. And also we've got earthquakes out here. So like, you got to check your foundation, right? Like, so, everybody, you have your own things like, so that was it.
Cool.
Okay. Makes sense.
I'm good. Anyone have any questions about how we found that property? What are you doing with it now?
I have one quick question. See the $200,000, the two $200,000 numbers, the down payment and the work that you're going to do on it. You used the HELOC, so you were the acquirer, and then you did four $50,000 promissory notes to people,
Correct.
And then you were out on the back end, or were they cool with the buy and hold switch?
Yes, because with the buy and hold, I did a cash out refinance, which allowed me to get all of the money to make my investors whole. So everybody got paid out, and then I'm the only one who left money in the deal, which is another part of it. But yes, that's exactly right.
Okay, that's cool. So you're really like, whatever money you were in your reserve accounts or your other investments or whatever, you didn't have to touch any of that because you just got your HELOC sitting there waiting. So your HELOC up to be able to close. You didn't have to have a $400,000 HELOC, otherwise so you were able to just distribute some of the risk of the opportunity. You didn't keep as much of the pie because whatever your investors made, you would have made, but you would have had to put 400 into it.
Yeah, but it wasn't that. I mean, whatever, 8% on 200 grand over 6 months isn't that. I mean, it was like thousands, but it wasn't like, they're not getting rich off of it. Like,
right.
But for them, they're like, this is great. You know what I mean? I've got money sitting in an account, like one of them was my dad, truthfully, who he just has money in an account. I was like, Dad, what are you, oh my God.
Right. Like for one of those people, what's their outcome is they give you 50 grand. It's backed by the mortgage of the house. So if it sells, they get paid out before you, I guess, or whatever. And then So they're secured by the real estate. They're gonna get 8% over 6 months as interest, and then they get their 34% if it's sold. Like what was
Oh,
their?
no. Sorry. They're only private money, like hard money. There's no equity for them. They get the 8% on their money that I borrow.
That's it. So
Yeah.
they're just saying like, I got to sit in here, but I'm guaranteed 8%.
Dude, yeah. Oh, my bank account's going to give me less than 0.5%. Treasury bond 10-year fixed is like whatever, 1.5%. 8%. Are you kidding me? Secured
Right.
by real estate? Oh my God. Yeah. Sign me up.
And,
Right.
and there's something I want to add to that is that there is a heartstring factor, right? You're a likable person, you've established relationships, and you're trustworthy. Like your dad, your dentist, whoever it is, who's like, and I'm helping out Brad. This is cool. He's starting a business. He's starting a family. This is like, I guarantee you that was a part of it. Their willingness to give you 50 grand to earn 8%. Like financially it makes sense, but also they're helping out a good guy. Like you've been a trustworthy person. And I think
Okay.
we should all remember that, like to just be a good dude and people will probably trust you.
Yes.
Or female. Do that.
So the lesson with that is this: at this point, I wasn't telling anybody about anything. And we were whole hog in on our 10 unit in Phoenix, like full on renovation, like a huge project that we took on that like, man, we don't have enough time. If you guys are interested in this stuff, like we could talk about that even next week, potentially, because that's a whole other thing that I thought was going to be like a base hit and it ended up being a home run. And it's like the best thing ever. But so, my wife, oddly enough, the one who like didn't give a rip about real estate was like Miss Chatty Cathy with everybody about what we were doing. So then randomly, like one of her coworkers and some of our other friends would hit me up and be like, hey, like, I know you totally don't even need this, but like we'd be interested in investing with you. Like we have some money set aside. So like, if you're looking for like investor partners, like we'd love to be part of it. And I was like, you gotta be kidding me. But I wasn't vocal about it because truthfully, I have a huge fear of letting people down. It's part of the reason I was very successful when I got into real estate. And it's the reason that I wanted to have like a proof of concept and take basically a couple of these projects through like their full life before I started reaching out to like my own sphere. My wife jumped the gun on that a little bit, and people, without even having like having successfully executed it, to speak to your point, Jeff, they were like, well, Brad's trustworthy. They know that I'm like a financially responsible person because like I just nerd out and talk about this stuff, and they knew that I knew that I was doing. So that was it. Now, the way that we also, aside from how they like us, we also protected them with this promissory note. So like, Lord forbid, if something were to happen to my wife and I in a car accident, this wasn't just like some back of the envelope like agreement. It was a notarized document that said that they had a position on the property that, like, while it wasn't recorded on the title at that time, if and when something were to happen to us, they could just go to the county recorder and they would be made whole. So we wanted to make sure that all of that stuff was taken care of because
Who created that document for you? That promissory note?
dude, we just like found one online, like a legal
Okay.
Zoom type thing. Super easy.
Okay. I've done the same thing, but I was wondering if there was a better source. But basically, I did the same thing. You just Google a promissory note, read through it, make the changes that are appropriate to your transaction, and then just use that and sign it and have your notary notarize it. It's not,
and if we were,
it's not as complicated as it sounds to create a promissory note.
no, not at all. Like, it's easy. So, and most of the people didn't care. Like, they just literally didn't care. I had to be like, we're going to do this. And I mailed it to you. Did you get it? Like, they didn't care. But anyway, neither here nor there. But so my point is, just like you would tell a real estate, don't be a secret agent in real estate, and don't be a secret investor. You should be asking people like, oh, you have anything interesting? I'm looking for fix and flips, or I'm looking for duplexes, or I'm looking for small houses on a big lot, or something with a detached garage that I can convert into like an apartment, right? So if I can tell people now their RAS, the reticular activating system, is honed in on that. So when they get that thing, I hope they can take it down, but then I want them to think of me. So anyway, that's that. So let's see, what were my takeaways with this? Oh, carrying costs.
Hey, Brad.
Yeah, babe.
Sorry, I'll cut you off. I'm here with Gil. I'm Sam.
Hey, buddy.
It's all really helpful. The 8% on the hard money, where did that come from? Where did that number come from?
Sure. So that was what I was going to have to pay to this other, hard money lender, but I was going to have to pay points. Most hard money lenders will charge you like, probably 2 to 3 points to originate. Like right now I'm at a point where I could get a deal with 7.5 to 8% interest, 1 to 1.5 points for a deal. So I was basically matching that. Now, let me be clear. If you just go to like a random hard money person, now if you're getting started, they're going to charge you 11, 12, 13%. They're going to want 3 or 4 point. It is insane. The numbers don't pencil out, but it's almost like a chicken or the egg, right? Like they want to know that you've done 5 deals within the last 2 years, at least out here. So 5 deals, but I need the money to get started on the first deal. So it's like, what's going to give? So that's why this worked out where I was like, okay, I could take this down. And then the private money, you know, they didn't care. I mean, there's people we knew with cash. So 8% seemed fair. Nobody was like balking at that. I mean, could I have gone to 7 or something or lower? Probably. I mean, they didn't, you know.
So you took what the like the local lender or the searchable lender would have taken you and just brought that to friends and family and said, listen, this is reasonable. This is kind of like an industry standard, something like that.
Yeah, I just said like, and I didn't offer up the points. Truthfully, I wasn't like, I'm going to give you a point and I'm going to do. I was just like, look, we want to borrow money up to 6 months. I can pay you 8%. Like we're going to draw up a promissory note held against the property. What do you think? And they were like, yeah, no, they did. Nobody batted an eye. It could have been 7% or something even less, but
It probably depends. It depends on the person you're going, like, I'm just thinking out loud. Like if I went to my dad, right? And I said, can I borrow at 8%? He's a negotiator. He'd be like, oh, I'll do it for 12, you know, like.
Well, yeah, I called a buddy of mine that's this wealthy guy that sold his company. And he was just like, man, 8%, like I'm losing money. Stock market's raging right now. You know what I'm saying? I'm in this, I'm in that. But you'd be surprised how many people, well, you wouldn't be surprised. Very few people are sophisticated with money. And most of them are sitting on a lot of cash. And so they're just like happy to do something. Also, they're investing in real estate, man. It's like, it's fun. It's sexy. It's just like being involved in like a restaurant, except like, you know, people love that stuff. So now they can be like, oh, I'm on a deal. Or you're like, oh, okay. So, but they didn't have any equity. They just had, they just let me borrow money, frankly.
Just the hard money. All right.
Cool.
Correct. Yep.
Lauren,
okay. So
Lauren, how are we doing on time? Is there anything you want to make sure we cover? We're in that last quarter of the hour here.
We have about 13 minutes because we have a hard stop at 1 p.m. Eastern Standard Time. So I know we've been taking questions in between. So if Brad wants to go a little bit longer, and then we can kind of open up like the last 5-7 minutes for questions or comments.
Sounds good.
I'd love that, because there's one big thing that I want to put a whole bow on this, which like, I hope it blows your mind the way that it should blow your mind, but we'll see. So this is the refinance. This is that same property that I decided to refinance, or also like within the bigger pockets world or investing world, they call it a BRRRR strategy, B with 4 R's: buy, renovate, rent, refinance, repeat. So this is the other part of it. I learned about something called accelerated depreciation, which is, I don't know your political affiliations, but in my opinion, it's the only good thing that Donald Trump has ever done. And it happened to really incentivize real estate investors specifically. So how it works is, for a non-owner occupied or any kind of like income producing property, you can take what's called a depreciation, right? Like can you see me? It says my internet's unstable. Okay, so you get your depreciation. So you have $1 million property. There's a certain value that they give to the structure and then to the land. So the land is never going to be depreciated. It just is. It's land. But the structure, they give you the IRS will give you a reasonable paper depreciation, a paper loss for, like, you know, the roof and the windows and the siding and the plumbing and all the stuff that's going to like slowly come down, similar to capital expenditure, but the government will give you that money. A normal schedule is over 27 years, right? So you get like 1/27th of a certain point and your tax basis goes down. I hope you guys are following along. This is something that you have and you can access it on investment properties. What the Trump tax bill did is it said that you could take that 27 years and hyper accelerate it and take that full depreciation in 1 year, which is huge. You could take like $100,000 crazy losses, paper losses, to offset income. But here's the best part, is that because we are real estate professionals, we have reps, real estate professional status, you can take that paper loss 100% against your normal income. Where if you were just a W-2 earner, you could only take that loss against the money you get through real estate. So like, for example, my buddy who's in biotech sales, and he has a huge portfolio, like 30 units all across like Tennessee and Arkansas. So if he were to get a $100,000 deduction, he can only hold that $100,000 deduction against the $30,000 he earns a year from his real estate investment. I can take that same $100,000 deduction and hold it against my full GCI, the full amount of money that I bring in, which is huge because then I have an incredible tax savings right now this year. Now my tax basis is lower. Okay, sorry. Does that make sense? Do you guys understand that? It's like kind of like an advanced strategy. And most people don't know about it because either one, they're not investing in real estate, or two, they don't have the rep status. So like, it doesn't mean as much to them this year. But my point is like, man, for fear of sounding braggadocious, but let me just give you the rundown. In 2019, it was the first year that I earned $1 million GCI. Okay. I think I profited, I don't even remember what, like somewhere around like 650 was like my take home off of that. My tax bill that I paid that year was $180,000. 2020, I used this what's called cost segregation, the accelerated depreciation. Granted, I earned a little less at like 850 GCI, but I was just as profitable. But because of the power of the real estate stuff, I paid $18,000 in taxes. So I paid 10% of the taxes. I could use that. It literally, this study on this property specifically saved me $85,000 on my tax year.
Wait,
So
say that again. What was your tax bill in 2019 compared to your tax bill in 2020?
180 grand. And then in 2020 was 18,000. So 10%.
Unbelievable. A 6-figure difference in your take home
Right.
that year was because
Now,
of the strategy.
I made $150 less. I mean, that's also part of it, right? So like that factors in, but nothing else different. Like I didn't buy a car. We didn't buy a new home. We didn't do anything. The only difference was that I bought 2 properties in 2020, and I used this, what's called cost segregation, this accelerated depreciation. So anyway, my point is now that if I knew that I was going to use this strategy, if I could save 85 grand, and I didn't have to pay the $50,000 in closing costs for the realtor fees and for the, whatever. I don't pay the short-term capital gains. I don't pay whatever. I was like, oh my God. So it almost penciled out that I could basically do a lot more. So let me walk you through this. So now instead of selling it for 1.25, it appraised a little bit over 1.2, right? I had my personal money invested was the 270. And then this was the 50K rehab overages, 20,000 in closing costs, 200K. So my point was that I could only refinance at 822 because that's the high balance conforming loan. So I could refinance at 822. I've got my property taxes, 1,000 in for insurance. My monthly nuts 4665 is what I thought. It's actually like 4,500. I rent it for 5,000. I've got a gardener for $100. I manage it myself. There's no capital expenditures because everything is brand new because I just renovated it. And I factor $150 a month for repairs. So all in all, I'm basically barely breaking even, right? I'm only making a little bit of money, but I've got $400,000 in equity, right? Because this property is worth 1.2. I owe 822. I now don't have to like give all that money to Uncle Sam or to realtors or, closing costs or whatever. So basically the refinance amount, my current loan balance at that time was 533. So I cashed out 269. I gave 200 grand back to my clients and there was 69,000 back to me. And I had, total cash invested was 270. So I still have $200,000 in this deal. So my cash on cash is 0.5%. Now that's not good. So if you look at it like this, the return on my 200 grand is not good. But let's remember, I saved $85,000 in my taxes. And I'm very bullish on this neighborhood. So now I have a $1.2 million asset that I'm seeing 12% return in appreciation. So I'm not so worried about cash on cash because this neighborhood is going to go up in value. So when I in 2 years, I can sell this, do a 1031 exchange, pay no taxes. And by that point, then I can get as much money back into that other deal and then just basically keep it going forward. So does that make sense? Like, and then taking it a step back, I can keep 200 grand in the deal because I don't need it because I'm conservative with my finances, right? Like I'm parking this here temporarily. So that way I can then go and acquire like other properties. So that might've been too high level. I hope you guys, your eyes.
It's an appreciation play in one way because you're going to make $100,000 to $150,000 a year in appreciation because you believe in this community.
That's exactly right.
And there was even though you're earning 0.5%, you actually earned $85,000 on this thing because of the tax benefits. So there is an immediate payoff as well as an appreciation play, even though it pencils as a break even.
That's exactly right.
That's awesome.
So it pencils as a break even on the cash on cash return. But if you're looking at overall big picture, that's when I was like, holy smokes. Here, listen, the crazy part with the cost segregation is that I did what's called a two-part study. I did a part on the crummy 1970s house. I was able to take the tax loss in 2020 on the 80s kitchen, the 80s bathroom, the plumbing, the electrical. I ripped all that out and threw it in the dumpster. And then I can now do a cost segregation study on all the new stuff for 2021. So it's a two-part study. So I'm not just going to save the 85. I'm probably going to save closer to like, I don't know, 120 or something overall. It's insane. I'm like, you mean to tell me I can take a paper loss off this crummy toilet that I'm going to throw in the dumpster? And they're like, absolutely you can't, because that's the way the tax code is written.
That's awesome. All right, we are in our last 5 minutes here. So let's give everyone a chance to ask some questions.
Is that
Dana's texting me on the side. I'm thinking he might have a question.
So, what was that, Gil?
I was just gonna that cost segregation thing, is that something that's just on new acquisitions, or is that on existing properties as well? How does that work?
Yeah, anything existing. Truthfully, it's a few $1,000s to get the report, but most companies, like any sort of a cost segregation company, they will do like a free analysis. So you send them the address and you tell them, and they'll be like, oh, we think we can do, we think that you could save 50 or 60 grand on your taxes with this. Now, let's be clear. When you do the cost segregation, your tax basis goes lower. So if I were to just sell this and not do a 1031 exchange, I would pay more taxes on that depreciation. Let's be really clear, right? My tax basis is lower. Do we all understand that? So like it's
No.
just like with a flip. Like it's my purchase price is 800. If I take the depreciation down to 600, well, now I'm going to pay the taxes on the gains off of the 600, not the 8. But my plan is to just do a 1031 exchange. So I will just keep deferring these capital gains, and then one day my kids will get them, or I'll just give them to somebody else. I don't know.
Okay, so if you're planning, yeah, I got it. If you were just gonna flip it in a year, your capital gains would be, you'd be paying on the spread because you made 200 grand because your cost basis is now 6 because you took the depreciation.
That's right. And this really makes sense because I can save 85 grand on a $1.2 million house. My $135,000 duplex in Michigan that's turnkey that I did no renovations to, it doesn't make sense for me to pay 2 or 3 grand for a cross seg to save a few grand. But if I owned 10 $100,000 duplexes, I could do like a sort of a portfolio analysis, and maybe that does make sense. So the way that this works best is like in places like this with the appreciation, I can take the paper loss, and then I keep planning on buying properties. So like I'll have more depreciation opportunities or loss opportunities in the future because I plan on keep buying more stuff and just keep doing this.
It's crazy.
It is. And let's be clear, this is an appreciation play in LA. Well, if I can get 1, 2, or 3 of these, I could sell this in 1031 exchange. And you're like, well, you're keeping your money in the deal. Well, yeah, but if I go buy a 60 unit apartment building in Tulsa, Oklahoma, that's just printing cash, like, what do I care what my equity in the deal is if I'm making $30,000 a month off some apartment building, right? Like, that's how, like, in 5 years, I'm going to likely trade these LA properties up and then buy larger multifamily is my plan. And then, whatever, hopefully my kids aren't jerks and then I leave something to them, or if not, I whatever, give it to somebody else, to Jeff Gray. Yeah. So again, this is a problem if this is interesting if you've got the problem of you're making too much money. As like as a punk rock kid from Michigan that like only wanted to make $100,000 a year, it's a little difficult to understand like tax strategies of people that are earning millions. But these are the types of things that wealthy people do to secure and just have their money so they can then go and reinvest it. I'm not going out buying boats. I'm not getting Rolexes. Like, all of my money goes into tax deferred accounts that I invest in broad index funds. That's my set it and forget it money. And then I buy, ideally cash flowing real estate or appreciation real estate or opportunities in real estate.
Brad, I want to say thank you, because someone just pointed out to me on the side here that this is all stuff, we're all real estate professionals and we're all have some awareness of this and some understanding of this. The difference is you took action on it. You did the study. you took action, you had some, you say you have paralysis analysis, but you don't. You're doing it, man. And it's inspiring and educational. And I really, really appreciate you sharing this with us today.
Well, thanks, man. I appreciate that. And I would say I have less analysis paralysis now. And what I would say is you don't worry about all this right now. It's just like with anything, like you just want to know what the next best step is. So again, let's start at the beginning. When opportunities come along and you're like, I think there's something here. I believe in this neighborhood. This is a vacant duplex. I know this thing is worth more. Just ask yourself, like, what would it look like if I tried to buy this? Or who could I partner with? Or how can I analyze this deal? That's step number one. And then the other thing that I'll say too is this serves you as an agent, because if I can speak much more confidently about the wealth building opportunities of real estate to my clients. So now it's much easier to be like, well, this is what I'm doing. Like, this is my, I've amassed a certain net worth in 5 years that like, it isn't from hitting 1 million GCI. I mean, that helps, but like, that's not what where I'm at now is only because I've executed like these strategies, and it's simple stuff. And again, I'm not like an overly intelligent guy. I just have no ego. And so when an opportunity presents itself, I could say, hey, I don't know anything about this. Can you explain this to me as though I'm a 12-year-old, and like in the simplest way? And if they're like, blah, 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 I'd be like, I'm so sorry. I still don't get it. Like, can you simplify it? Even like, I have no problem going in somewhere and saying, again, I don't know anything about this. Please help me to understand it. And then
That's
people
awesome.
are like willing to do it. And so that's what I would say. The no ego is probably my biggest strength. And, and I just, again, it doesn't need to be a home run. It just needs to be getting me a little bit closer there, because over time, whether I sell it, even if the market crashes in 2 years, like who cares? I'm still getting the rent, but in 10 years, that property is going to be worth so much more, just like, as we all know. And how many times is it like, whatever, I'm going on and on and on.
Yeah. Save some of this incredible stuff for, I think you're on again next week. And
if it's helpful, I'm happy to come
after,
back.
It's after 10 a.m. here, and it's after 1 p.m. there. So I think we got to cut it off, but thank you so much, Brad. Appreciate you.
Thanks, Brad.
Yes. Thank
Brad.
you.
Appreciate
Thank you,
it.
Brad. That was fantastic.
Yeah,
Great.
whatever. I'll be back next week, and then I'll give you all my info and we can just go from there.
All right, awesome. Thank you so much.
Of course. Okay. See you guys.
Bye.